Don't even think about setting up an SMSF if you're gonna buy a shit asset. I'm your host, Tony Shah. Thanks for joining me on another episode of the Mortgage Chat. Today, I'm gonna explain to you why setting up an SMSF and buying the wrong asset is the worst thing to do. First, you have to understand what an SMSF is. Self-managed super fund. I'm not going to go through it today because I've got a video up here explaining everything. So please watch this video if you don't know what an SMSF is. Okay, so let's drill down on it. When you set up an SMSF, you have to buy the right asset. If you don't buy the right asset within your SMSF, you might as well just left it in your industry super fund. And I'll explain to you a little bit more what I mean. So on a regular basis, we get people calling up that want to set up an SMSF and want to leverage and buy a property with it. Great, but you have to understand you have to buy the correct asset within that SMSF, leveraging and getting a loan through it only if it makes sense and it's got good potential growth on the property. And what do I mean by that? Well, for example, let's just say you're in the super fund, you got $200,000 in it. Call it CBUS, call it Q Super, call it Hester. Any of those major super funds, okay? You got $200,000 super balance in it. It's earning you 8% every year for the last 5 years. $16,000 worth of growth for not doing much, which is fantastic because you don't know how to invest the money yourself. So you leave it for the industry super fund to invest it for you, okay? Earning you $16,000 compounded every year, which contributes to your retirement fund, which is fantastic. Now, if you're a little bit more risky and you want to earn more than $16,000 every year from your industry super fund, what some people are beginning to do is they leverage up that super balance and get a loan against it to buy a property. And you can only do this when you set up an SMSF. But when does that make sense? It only makes sense when you buy the right asset within that SMSF. Now, within that SMSF, you can buy whatever assets you want that meets the 828 guidelines. You can use that SMSF to buy stocks and invest in the own stock allocation that you want. But for this video, I am purely only talking about leveraging, getting a loan, and buying a property with it. So remember, this is not financial advice. I'll just give you a guideline when is the right time to set up an SMSF and when it's not the right time to set up an SMSF, especially when we are talking about what type of assets we're going to purchase in the SMSF. Okay, so we have a lot of investors that want to come, that want to leverage and get a loan and buy a property within the SMSF. Now, 20% of the time, they want to buy an apartment. Okay, now let me tell you right now, 80% of the apartments around Australia don't grow in value. But today, let's use the Western Sydney area, okay? And let's just use Blacktown and Rouse Hill as an example because they were in close proximity where they want to buy a property in the SMSF with. So, like I just said, if they left the $200,000 in the industry super fund, they were going to get $16,000 every year, compounded year on year on year, assuming the returns are 8% every year. Okay, so that's an assumption right there, right? Now, if they want to leverage, use that $200,000 as a deposit and purchase a property within the SMSF, for in this example, they were going to buy an apartment around Blacktown or in the Rouse Hill area, they would have lost money. And I'll tell you why. Because apartments within the Western Sydney area hasn't really grown the last 10 years. You're lucky if it even grew 5% the last 10 years, okay? So if it doesn't grow in value, it's costing you money to hold the property and all the fees on it, and you're losing out on that 60% growth every year on that industry super fund, then you're going backwards, right? Because it's costing you money to hold the loan, it's costing you money to maintain the SMSF, and there's no growth in the property. So therefore, you actually gone backwards quite a fair bit and you've actually lost money within your initial super fund because the rent is not going to cover the P&I repayments. Okay, so as an example, what I just used before, the average initial super fund growth the last 5 to 10 years has been 8%. And that's about average across all your major industry super funds. Okay, so 16 grand right there. Now, so if you use that 200,000 and you leverage and purchase the property with it for 500,000, and that property only grew by 4% every year, that's only $20,000 worth of growth, right? About half that accounting for accounting fees, which is about $2,000 to $2,500, and also money that's going to cost you to pay back the loan because of the interest charges. Guess what? Your net profit is actually going to be lower than $16,000 every year. So guess what? That means you've actually gone backwards on your wealth creation within your super because you purchased a shit asset. You might as well just left it in your initial super fund where you're going to have less risk and less headaches and you're going to keep on growing. While this one, you've actually gone backwards in comparison to this one right here. Okay, so where does that make sense? I say to a lot of clients, it only makes sense if the asset that you leverage and purchase with grows significantly in the long run, more than within your industry super fund. Like I said to you, please only use this as a guide, okay? This is not financial advice. So my rule of thumb is if I'm earning 8% here, which is 16 grand, I expect to earn 8% here on my asset that I'm going to leverage and get a loan against. So for example, if I buy something for 500,000, I expect this asset to grow by 8%, which is 40 Gs. So now it makes a bit more sense because I'm taking on the risk for getting a loan and buying a property with it, okay? So 40 Gs here, it's 16 Gs here. So the difference on that is 24 Gs. But remember, you have to account for a counter cost and the interest charges. Yes, you're going to get some rental income back from the property with the SMSF, but it's not going to cover the whole repayments. Even at interest only, you're going to borrow 80% of the loan. I can guarantee you the rent doesn't cover the repayments unless obviously the rental yield is like 8%. 9% or even 10%, because industry super fund, the rates are always going to be a lot more higher than investment home rates, for example. And at times, it can be anywhere between 1% to 1.5% more expensive than a normal home loan. So you have to make sure that you work out a cash flow and a budget to understand that it's sustainable, right? Because if the rate doesn't cover the repayment, guess who's going to cover the shortfall? Your employer contribution, right? So for example, if my repayments are $3,500 every month, principal and interest repayments, and my net rental income is only $2,000, well, I'm short $1,500 per month. Who's going to cover this shortfall? It's going to be my employer contribution that has to cover the shortfall. So that's why it's very important to work out your cash flow before you jump in and buy something within your SMSF. So like I just said to you, my rule of thumb to make sense, setting up an SMSF and buying a property and leverage is when the asset that you're going to buy, call it a property, has the most potential and the highest probability that this asset is going to grow a lot more faster than this asset dollar value. Okay, that's the only time it makes sense. If it doesn't make sense, and for example, if you come to me tomorrow and you want to set up an SMSF and you want to buy an apartment with it, I'm going to question you a lot more to make sure you understand the potential growth of that property. Now, if you come to me and go, we want to buy Blacktown, we want to buy in Macquarie Park, we want to buy in Carlingford, Rouse Hill, Kellyville, Parramatta, North Parramatta, more than likely, I'll say, you know what, that's a very high risk and it's something that we don't want to do. Even though that you understand the risk, we don't want to take the responsibility of doing that loan because we only want to take on clients where we know they're going to buy a great asset within the SMSF. If they don't buy a great asset within that SMSF, it's more than likely we won't proceed with you as a customer. So please understand, it's very important to find the right asset, okay? And if you're in Sydney and you don't know where else to look, well, guess what? Check my mate up here, Prop Spotter. Sean, he'll guide you in where you can potentially invest all around Australia. Now, we did have someone that goes to us, Tony, yes, buying an apartment may not be the right growth asset, but it's going to give me great rental yield. Yes, you are correct. Maybe it'll give you great rental yield. But remember, when you buy an apartment, there are a lot of costs involved with keeping an apartment, especially with the strata levies, okay? So for normal home, a house, the cost of holding the property, such as expenses, property management, insurance, water rates, council rates, we'll like to use anywhere between 15 to 30% as an expense of the total rent. Just as a rule of thumb. Sometimes an apartment could be up to 40, 45% or even 50% of the rent that you're going to receive because there may be special levies or strata involved. So even though the gross yield may be 5.5%, 6%, but after all those expenses, that gross yield may drop down to like a 3.5% net yield. So it doesn't look so pretty after that. Okay, so irrespectively, some of them go to us, Tony, yes, I know, the property may not grow as fast, but we are interested in the rental yield. Now, they may be able to get 5% rental yield or 6% rental yield on that property once they pay it off, right? But if you leave that money in your industry super fund, well, guess what? You're earning 8% every year. So 8% in comparison to 6% is a big difference of 2% gap. Now, you leaving the money in your industry super fund for an extra 20 years in comparison to you trying to pay off that loan in the next 20 years, then reap the rewards of getting 6% every year with a asset that doesn't grow, well, guess what? I can guarantee you the total net value of the assets that you hold with the industry super fund outweighs you holding a property with good rental yield with your industry super fund. This will outweigh this. I can guarantee it. Okay. So that's why I always say, guys, please buy the right asset before you set up an SMSF. Okay, or at least do some research. See what you can afford. Get some planning involved before you set up an SMSF and dive into the world of leveraging and buying a property with it. Okay, so here's a good example of how our clients done really well setting up an SMSF, leveraging, and purchasing a property. This is a good example because this suburb where Sean PropSpotter helped them locate was actually in the Australian Financial Review as the top 10 performing suburbs in Victoria. Okay, so the area was actually in Frankston North and it grew by 19.5% or thereabouts. Let's call it 19% for argument's sake. Okay, so they purchased a property for around the low 600s, and guess what? It actually grew by 19% of that value. So let's call it 19% of $600,000 on the asset value. That's $114,000 worth of growth in 12 months' time. Now, if they left the money in the interest super fund where they had $250,000 balance, growing 8.5% every year, the growth on that would have been $21,250. So you see, in this scenario, they're purchasing a property actually five-folded in comparison to leaving it in the industry super fund. Obviously, it's not going to grow by 19% every year, but in the long run, we are hoping, we're going to get around 8 to 10% growth year on year, or average out over the next 10 years because we want that. So therefore, it justified the clients investing in taking on the risk, getting a loan, buying a property with the super in comparison to leaving it in the industry super fund. So there you have it, everyone. Please only use this as a guide. It's not financial advice. Please always talk to an accountant or a licensed financial planner to ensure setting up an SMSF is the right vehicle for you. This was only a guide to show you when and when not to set up an SMSF because buying an asset is very, very, very important. Now, I'll also have a lot more videos up here on my YouTube channel, but please also look at PropSpotter up here and see what he can do for you and help you out in selecting the right location. As always, thanks for joining me on another episode of the Mortgage Chat.